Okay, welcome back, everybody. Here is now the promised second half of that short little lecture on hidden reserves and exit taxation. The the current case or situation which we are going to have a look on is that not a shareholder but a company moves abroad. And in that case, it might be, in certain circumstances, possible that afterwards Germany has no longer the right to levy a tax. For that situation, there has been created also an exit taxation of the shares for the shareholders. So here we still look at the shareholder level. The question, which is our question at the moment, is simply, do we need to tax the shares because due to the moving company, we lose the right to tax the shares of the shareholder? That, well, can that be the case? Let's just use our common sense. If you are a shareholder who is subject to German unlimited tax liability, it does play no role if the company is in the inland or abroad, so if it's unlimited or limited tax liable in Germany. So there will probably be no need to react. If the shareholder lives abroad and is subject to limited tax liabilities, there it might play a role, because under limited tax liability you are only taxed if you sell shares in a German company. Now, German is, from the perspective of tax law, a company which is subjected to unlimited tax liability in Germany. Now, if the company moves and unlimited tax liability falls away, that would mean that the shareholders' shares fall out of the scope of paragraph 49. So a shareholder abroad could no longer be taxed under national legislation. So there the case could become relevant. It might be that a DTT, a double taxation treaty, might grant to Germany, under extraordinary circumstances, the right that also Germany might levy a tax on the shares which are held by a foreign shareholder. That might be, for example, the case in that extraordinary constellation mentioned in Article 13, that a company's value is made up mostly by inland immovable property. So if you have a house and in the inland and that house constitutes nearly everything of the property of the company. So if that company would be moved abroad, nevertheless, Germany could still be taxing the shares. But these are rather rare situations. So the most relevant case will be the case where a company leaves Germany and the shareholder lives abroad. Well, now, if the company which shifts its seat and place of management abroad is an SE, Societas Europea, or an SCE, Societas Cooperativa Europea, then the Merger Tax Directive in its Article 8 strictly forbids a treatment where the transfer of the seat and place of management triggers any tax on the shareholder level. So in that case, although the need would be there to levy a tax, it can't be done. Here the German law reacts in that way that we decide to levy the tax afterwards when the shares are regularly sold, in spite of the fact that a limited tax liability is no longer given under the usual rules. So there we extend our limited tax liability to shares in a now foreign company, and we insist in levying that tax even in breach of double taxation treaties. So we established here a treaty override clause concerning that special situation, that an SE or SCE transfer their seat and place of management, and therefore shares are lost for the further German taxation. That is all something which happens relatively rarely. Nevertheless, one can imagine how cases might arise. So it depends very much on the situation of the individual shareholder. So there is no general triggering of the share gains taxation in cases where a company moves, only in case of those shareholders for which problems arise. Shareholder A lives in Munich, shareholder B lives in Paris, France, and shareholder C lives in Monte Carlo, Monaco. Now the company is ABCBV, so it's a company with the seat in the Netherlands. But until now, it has its place of management in Germany, and now it moves that place of management back to the Netherlands. Therefore, it is no longer in the future, from the tax perspective, a German company. For this reason, the German state can, under the usual principles, in the future no longer tax the shareholders of ABC within their limited tax liability. So the problem does not affect shareholder A because his or her shares can be taxed under unlimited tax liability and under Article 13 of the Double Taxation Treaty also in the future. Shareholder B is not affected because already before the transfer of the seat and place of management, Germany has had no right to tax the shares of that shareholder. Article 13 of the OECD Model Convention, or better, the article which corresponds to that article in the Double Taxation Treaty Germany-France, will preclude us from levying such a tax already before that maneuver. So we have no tax possibility in advance, and we don't have any tax possibility afterwards. So no damage is done, no change in the situation. That is different when we come to shareholder C, because with Monaco, the Principality of Monaco, Germany has no tax treaty at all. So the German EStG rules come to application in full extent, and that means before we have a shareholder limited tax liability and the company in question is a German, from the tax perspective, a German company, so the shares would be taxable, selling the shares would be taxable under paragraph 49(1), I believe it's number 2E. E like England. Yeah, and afterwards we have a shareholder who is no longer shareholder in it from the tax perspective, German company. So now damage is done, we lose the right to tax these shares, and so we have the extraordinary situation that paragraph 17(5) EStG applies. An exit taxation is triggered, so shareholder C has at the moment when the company moves back to the Netherlands, shareholder C has to pay taxes on the hidden reserves in the shares at that moment. Now let's vary the situation a bit. We have ABC and they hold shares in the ABC SE. The SE now moves seat and place of management from Munich, Germany to Paris, France. Consequences: for shareholder A, nothing happens. For B in Belgium, nothing happens because the DTT already excludes Germany from taxing the shares before everything happens here, so nothing changes. We do not lose something, we had nothing to lose here. But again, shareholder C is a shareholder which before the maneuver can be subjected to German limited tax liability, and that is not excluded by any double taxation treaty. So after the maneuver, Germany would under normal conditions lose the right to levy a tax. So we would usually trigger a tax claim an exit tax, 17.5. But, surprise, the merger directive of the EU categorically forbids any taxation of shareholders in connection with the mere transfer of the seat of an SE or SCE. And surprisingly, it does not limit this to shareholders who live in the area of EU or EEA. So Germany has to renounce on a tax on this. And to close the loophole or gap which arises here, the natural reaction is, okay, if we can't do it now, we do it later when the shares are actually sold by shareholder C, then we still levy the tax in spite of the principles of international law, and even in spite of a double taxation treaty, if there were some double taxation treaty to come into play. So shareholder C would then be taxed later when the shares are effectively sold. So paragraph 49 is here extended to shares in companies which originally were German companies some time ago. Okay. Now let's turn to hidden reserves on the company level. So different problem. And now let's turn. This is the assets. So now here we have for all business property a general rule in paragraph 4 EStG, which defines the tax profit. Paragraph 4 says, in principle, every asset for which the right to tax them is getting excluded or limited by, limited would be by the obligation to credit foreign taxes against the German tax. Everywhere where that happens, a taxation of hidden reserves happens at the moment when the change in the situation arises. So what we do in that case is we tax the assets as if they had been sold at that moment when the situation changes. And by the way, this is exactly the same problem constellation as in the case of a withdrawal of assets into the private sphere. So that is why the German legislation used the same technical term for that. They also call this a withdrawal. So you have a withdrawal of assets into the private sphere, naturally only with natural persons, and also a withdrawal of assets into the tax-free sphere abroad or under a double taxation treaty. So the difference between value in the market and book value, so the hidden reserves, that becomes taxable. Now again, we have the problem that if you transfer assets to another country under the EU fundamental freedoms, you are hindered to levy more taxes or levy taxes in a stricter way than necessary, because here you treat the situation less favorably than the comparable inland situation, and that is only allowed as far as it is absolutely necessary. So there is a special rule, paragraph 4G, EStG, which then says, okay, the gain which you realized from that transfer of assets abroad into a foreign permanent establishment, that gain does not need to be taxed immediately. You can distribute that gain over 5 economic years or 5 accounting periods by booking a reserve position on the liability side of the balance sheet in the moment when the transfer happens, and then by dissolving that reserve every year by 1/5 of the original amount at least. So that is granted, but surprise, only in cases within the EU or under certain conditions, probably also within the EEA. You will be able to enforce EEA cases at least in court. There is Then naturally another thing, if you withdraw not a single asset, but all assets of an enterprise into the private sphere, you would get a reduced tax rate and the one or other certain privilege. And so an additional rule has been created if not a single asset is transferred abroad, but a complete business is transferred abroad or a complete branch of a business. If the person in play is a natural person, then the event is then also taxed as if a complete business had been sold, 16.3a EStG, which has the consequence that you can claim certain privileges concerning the tax rate and perhaps under certain very rare conditions also a relatively small free allowance. And the tax here can be paid in installments, 5 installments, paragraph 36. The technique with the reserve is not applied here. The idea evidently is that the tax balance sheet for a German part of the enterprise is no longer possible from the perspective of the German fiscal administration if there is no longer a taxable part of the enterprise. This is rather an unnecessary idea because naturally one could say, okay, even a foreign taxpayer, as long as you have at least one entry in the balance sheet which affects German taxation right here, that reserve position, then you have to hand in a German tax balance sheet and compute your taxation accordingly in Germany. Although perhaps below the lines, that makes not a very huge difference. It could make a certain difference, perhaps, if, I wonder now, if our taxpayer also has German income from other German sources, for example, from rental income or similar things, because then it plays a role if you can add up 1/5 of the income together with the individual income of the other individual income of that current year, or if you just get calculated one single tax amount in the first year, which you then have to pay in 5 installments, because then you can't set it off against losses in a future year, which otherwise under the reserve technique you could do. Well, in case of a juridical person, moving assets abroad is treated exactly alike, only for reasons of terminology, I suppose. 12.1 KStG repeats the withdrawal rule, probably because some people say there can't be a withdrawal in case of a company because it has no private sphere. So we are logically hindered to treat something as a withdrawal. This is rather a fight about words. Well, 12.1 clarifies that the same as in case of 4.1 sentences 3 and 4. So the withdrawal rule also accordingly applies to company cases, and also the rule about the reserve for hidden reserves, which you transfer, where you transferred the assets into the EU states, that has to be applied accordingly. So this is just a clarification. Probably there is no big difference to the contents and basic idea of what I told you about paragraph 4. Well, a nice complication is in cases where a capital company transfers the seat and place of management to another state, and the consequence is that there is no longer the unlimited tax liability in any state of EU or EEA. So that you move your seat or place of management outside the EU probably, then it is automatically deemed that the company has been dissolved, so that liquidation has started, and that all hidden reserves shall be taxed. That sounds to be the same as in the first case, but the difference, ladies and gentlemen, is, well, here is no clause that you only tax the hidden reserves in assets where later you can't tax anymore. Here, that means if you move the seat and place of management of a company outside the area of EU or EEA, that then the all your assets have to be taxed at their market value at the moment, even those assets which afterwards remain taxable in Germany after the change happened. So this is rather a prohibitive rule, which makes shifting the seat and place of management of a company outside the complete EU and EEA so burdensome from the tax perspective that people will not do it but refrain from it. The same, by the way, applies if you transfer seat and place of management in a way that although the company remains subjected to unlimited tax liability in the EU, nevertheless, it is regarded as resident in a third state under a double taxation treaty, because that is usually decisive for the taxation of the worldwide income, and otherwise one could probably easily avoid, in cases of double residence of a company, easily avoid the rule of 12(3). So the decisive thing is, if you shift your seat and place of management outside the EU, or if you become a company of a third country, then everything has to be realized and taxed, even the assets which later could still be taxed. So here that's clearly excessive, but because you do something which is not regulated or guaranteed under EU rules, shift your seat to a third country, it's nowhere guaranteed. As you do something which EU law does not guarantee or protect, the state can tax you as hard as they want to, and surprise, they do, probably with the aim to keep you inside the EU and prevent you from moving to third countries, so to make use of, let's say, the tax competition or the tax advantages which you can get in third countries. Just to sum up, here you see an overview about the rules. So when it comes to the shareholder level, then you have paragraph 6 EStG if the shareholder moves, 17.5 if the company moves. Now when you come to the company level, so that the company moves, that can trigger 17.5 on the shareholder level, and the asset level, if something happens with the assets, then you have 12.1, 12.3 and 12.1 combined with 4G EStG. So these are the rules, the most important ones which exist in Germany at the moment. A special topic is that you do not tax hidden reserves but future income, and that you lose future income. That is relevant when you have income from pension schemes. Germany has a rule that contributions to certain private pension plans can be deducted as special personal allowances. So Sonderausgaben, special expenses, also a translation. You can deduct it from the tax base, and you get even additional, let's call it subsidies to the pension plan by the state. The background of the idea is later, when you get payments out of the pension plan, that will be taxable income. Now, if in the meantime you move to another state, then you will find out that mostly pensions paid to a taxpayer can only be taxed in the state of residence, at least under the OECD Model Convention, Article 18. If that has been agreed upon in the same way or a similar way, then that means Germany first subsidizes your pension plan by giving contributions and deducting the pension contributions which you make from the tax base, and later can't carry through the corresponding taxation of the revenue. So it would be a kind of a tax saving model. The expectation, if you move, the expectation we deduct the contribution because we have the expectation that we can in the future tax the revenue which flows from the pension plan, will be frustrated. For this reason, Germany tried to establish a kind of exit taxation also for taxpayers who profited from such a pension plan. That was paragraph 95 EStG. So these people have to pay back the state contributions when they leave, and they can do this in installments, at least if they pay back at least 15% of every revenue from the pension plan, which they get until they pay back these state subsidies. Now, the EU, however, criticized this approach. They said, well, moving to Munich is without any consequences for a German. Moving to Spain triggers that additional obligation apart from paying taxes in Spain. You are also forced to pay back additional 15% of the pension. This is explicitly not called a tax, so that you can't invoke the rules of the DTT, and you will not be able to credit it as a foreign tax in the new country of residence, let's say in Spain. So this additional payment, which is caused here, is a kind of an obstacle for moving abroad in the pension age, which would not exist in inland cases. So it's definitively a restriction to fundamental freedoms, for example, mostly to the freedom of people, of persons, who are not workers and not business people. So the EU criticized that, and the European Court of Justice said there is no justification because this obstacle is so drastic that it would remove the freedom of movement for a whole group of people effectively. Because if you are relatively wealthy, then you got enormous amounts or relatively big amounts of state subsidies, and so having to pay them back is rather a grave obstacle to moving. You can't afford to move then, probably, because one can reasonably suspect that you did not take part in such a pension scheme if you did not need that additional money, so you would be hit by having to pay back more than you calculated. On the other hand, if you are relatively poor and have to pay back a bit of your pension scheme revenue, that would also be a grave consequence for your net income. And so the rich would be hindered by having to pay high amounts, and for the poor it would nevertheless constitute a relatively high amount, so everybody would have to stay at home probably. So the ECJ said, apart from the financial consequences, there is nothing which justifies that. And there is probably no legal right or no principle that if I allow a deduction, my hope that later there will be revenue which I can tax cannot be frustrated. So they said, no, the proportionality, the relationship between the consequences of the restriction and the legal aim which the legislator wants to achieve, the relation between them is not appropriate. So they forbid this completely. For this reason, the obligation to pay back the state subsidies to a private pension plan nowadays only take place if the taxpayer in question shifts residence or habitual abode or DTT residence to a state outside of EU and EEA. Well, if the taxpayer, by the way, moves to Switzerland, for example, you are still working, you have contributed 10 or 15 years to a state pension plan which got subsidies, then you would have to pay them back. But if you change over to Switzerland in order to take an employment there, that would be protected by the EU-Switzerland Treaty on the Free Movement of Persons. So in that specific situation, you would probably also be protected, which the German law does not clearly and explicitly state. On the other hand, the EU-Swiss Treaty does not cover the free movement of persons for non-economic reasons. So if you first cross over to Switzerland after you retired, then you would be fully hit by paragraph 95 and would have to pay back your state subsidies for your private pension scheme. Well, yeah, a last question which arises is again, let's leave German law and EU law and let's turn to more basic or more direct parts of EU law, namely to the Anti-Tax Avoidance Directive. And there, the first thing which we have to notice is that the ATAD only covers cases in the area of corporation tax. So our problem with a shareholder, a natural person who has to pay taxes on shares, does not arise in the context of the ATAD. Nevertheless, some rules comparable to paragraph 12 KStG are in the ATAD. You find them in Article 5 ATAD. There is an exit taxation compulsory, mandatory for the member states on hidden reserves, and the events where that has to happen show up in Article 5. For example, a taxpayer, that means a corporation, transfers assets from the head office to a PE in another member state or in a third country. If the right to levy a tax is then lost for the original state, then a tax must be levied by the member states. If a corporation transfers assets from a PE in one member state to the head office or another PE in another member state or in a third country, again, in so far as the original member state has no longer the right to tax the assets, there must be a tax on the hidden reserves at the exit moment. And if a taxpayer transfers residence to another member state or a third country, then again, everything has to be taxed apart from those assets which effectively remain connected with the PE in the first mentioned state. So then a state of your unlimited tax liability will tax all of your hidden reserves all over the world, which now drop out of tax liability. And it might be that if the business of a permanent establishment is transferred to another member state or a third country, then again, taxes have to be levied, and so far as the original state has no longer the right to tax the individual asset which is in play. So here we can say there is a rule that individual assets, if they can no longer be taxed, must be taxed at the exit moment. And if a complete business or branch of a business is moved or drops out of tax liability because of a change from worldwide taxation to inland property taxation only, then also a tax must be levied. These are evidently the principles behind the rules of the ATAD. If you take that description literally, by the way, it gives extremely different results depending on whether a state applies the exemption method or credit method, because if you apply the credit method, the assets remain taxable in the state of residence of the taxpayer, although the state of residence loses revenue. On the other hand, in such a constellation, moving an asset abroad or something like that can never lower your total amount of tax. So in that case, where the credit method applies, we cannot have a tax saving constellation. And so it might even be justified not to oblige the member states to make an exit taxation in cases where the credit method is applied, because apart from the loss of revenue for them, there can be no tax saving effect. And remember, the ATAD is a directive which wants to prevent tax saving models. So if a state does not follow its own financial interest there is no legitimate aim to force them to do it, because, well, the main aim or purpose of the ATAD to exclude any illegitimate tax saving models is automatically reached by the application of the credit method in such cases. So no need for EU measures there, although naturally that does not preclude the states which apply the credit method to unilaterally act. Okay. Naturally, we have here also the need to postpone the payment of the taxes in question, because immediate taxation would constitute an obstacle, restriction which is stricter than necessary. So the ATAD also says the member state should, in cases where you have an intra-EU transfer of taxation rights, should offer payment in installments. Here they say over 5 years, if assets are transferred within or between EU and EEA states. Or if the residence is shifted between EU and EEA states. With regard to states of the European Economic Area, that is only granted under the condition that the EEA state in question cooperates concerning exchange of information with the original state in a way which is comparable to the EU rules over exchange of information. That's only a small detail. 5.3 ATAD then says that payment in installments can be subjected to conditions, so you can charge interest if that's usual in your legal system. The member states can demand guarantees where there is a risk that the tax amount cannot be fully recovered, and the deferral of the payments can be terminated if the assets are actually sold or otherwise given away, if they are transferred to a third country, so if EU law doesn't protect them anymore, if the taxpayer's residence or the business of the PE is transferred to a third country, so again, no protection for that under the fundamental freedoms, so no tolerance anymore from the fisc. And if the taxpayer goes bankrupt, or if the taxpayer doesn't pay the installments in time, because these cases D and E justify the suspicion that you will get some difficulties with collecting the installments. And so, well, if the taxpayer can't stick to the agreed timetable for payments, then naturally the underlying assumption or the basic principle, basic idea which justified agreeing on installments is no longer given. So naturally then you insist in, or may insist in, immediate payment. Well, in case that you transfer an asset between two member states of the EU or your tax resident, then, and that is very important, what the old state takes as exit book value, exit value, the market value at the moment when the situation happens, the new state shall then treat that exit value of the old state as the cost of acquisition in the new state. so as the book value, first book value there. The problem is that this is only mandatory if that exit value reflects the true market value, and naturally that can be debated. So if the new state, where the asset becomes taxable afterwards, just says, well, I don't believe that your old state fixed the market value correctly, then they can deviate. And the problem is, if you then can go to the European Court of Justice, you would probably have to bring forward objections in both states, and for reasons of, or to be on the safe side, just to say both made an error. In the new state, you would say they are completely wrong. The old state did take the correct market value. In the old state, you would have to bring forward, well, they did not bring forward the correct market value, and would have to complain in both cases, and then hope that one of the two courts hands up the case to the EStG, which then clarifies how the market value can be fixed correctly, or which state is wrong here. Because otherwise you have again a transfer pricing problem. And the question would be, can you then apply for arbitration? Can you invoke the double taxation dispute resolution directive of the EU from 2017? The question would be, is that a question which has or is related to a double taxation treaty application problem, or is it a different problem? So there are some interesting legal problems here. In the detail might be an interesting bachelor thesis topic, but only depressive people or those who want to become depressive will be highly interested in these details, because in advance you cannot know how much is in that topic. If it is just something which is solved after 2 minutes, or if you can really think about it for weeks. Okay. Well, let's turn to a last question, the exit taxation. Does the multilateral instrument of the OECD contain precise rules on that? That's not the case, because the taxation of hidden reserves is a mere question of how the tax base is determined and calculated. That is always not a question regulated in double taxation treaties. So the answer is no. Now, it would have been recommendable to establish a general principle, like in the former rule in the ATAD, that in cases where an exit taxation happens, the new state should accept the market value at the moment when the good came in as the starting book value, and that two values should be connected in a way that you would have a right that they should agree on the same market value at the same moment. That would have been technically possible if you override all the DTTs in a treaty by 70 states or more, but evidently nobody did it. Well, when it comes to the BEPS-project, also no really detailed provisions or suggestions there are made with regard to hidden reserves, so we can simply say that this seems to be everything which we can say there. So no detailed rules outside EU law and national law. So evidently on the global scale there is still some development to be expected, probably. Well, this was everything for this chapter. The next chapter will be probably the most important and most complicated chapter of the whole question here, the whole External Relations Tax Act, that is Controlled Foreign Companies Legislation, CFC legislation, or in German Hinzurechnungsbesteuerung. But this, ladies and gentlemen, is a story for another day. So enjoy that this small lecture now is over, and I hope that you faithfully look forward to the next lecture, which is going to come and then deals with CFC legislation. Thank you for watching. Recommend the channel to all people whom you like or don't like. Try to motivate them to share the lectures further, and try to remember something of the things which I told you just here and in the other lectures naturally too. Thanks for watching. It was a pleasure to talk to you, although I couldn't see you. Hope you come back soon and enjoy the rest of the day. Thanks and goodbye.